Good afternoon, Michaela. Are you able to hear me and see the slides that I'm sharing?
Yes, I am. Hello.
Perfect, perfect. I've got my fan on at the back because it's very hot today, but on your side everything is clear, nothing. So
Yes, I can hear everything.
perfect. We'll just welcome Leandy. We'll just give another few more minutes to see if there will be other students from the other campuses that will be joining us. If not, then we will start in the next 4 minutes. Thank you.
Thank you.
Do you have, Michaela and Leandy, do you have specific questions you'd like to ask me while we're waiting for other students to join?
I'm good.
Yeah. Okay.
There's nothing, ma'am.
Okay, perfect. Thanks. I think it's best we start because there's quite a lot that we have to go through. The recording will be available for the other students so they can always catch up. Welcome, Michaela and Leandy, to today's catch-up session for Accounting 1A. Very important. I'll give you I hope that you have your pen and paper ready to take some notes. I know that, Michaela, you have your textbook and workbook. I'm not too sure, Leandy, do you have your textbooks already?
No, ma'am.
Okay, perfect. Um, okay, also just note that when you are on campus and if you're still waiting to get your textbook from Wise Books, that you can take out a textbook at the library on the day that you have your lectures for accounting, and then at the end of the lecture you can return it. Okay, Leandy?
Okay,
Welcome,
thank you.
welcome, Vuhulwetu. Good afternoon.
Good
We've just
afternoon.
no, we've just started now for you where to. Um, from which campus are you?
Durban.
Durban. Okay, welcome. Okay, I'm
Thank you.
just hope you have your pen and paper ready, your textbook, your workbook. I was just inquiring from the other two students if they have their textbooks already. Do you have your textbook?
No, I don't have my textbooks yet.
Yet. Okay. So I was just also advising the other students that you can go to your library on campus and when you have your lectures for accounting on that specific day, just to take out a textbook, it would make things so much easier for you, and then you can always just return it after class. Okay.
Okay, thank you so much.
Much thanks. Okay, so we'll get started. Very important to note is that you must try and, you know, use your VC student intranet. Are you able to know how to go onto the website and to access the student intranet? Because it will be on this platform that the catch-up videos will be for PMIC and for ACBP. And also if you want to download any past papers, your module outline, all that necessary resources will be provided here. Okay. For ACBP 5121, very important within the module outline, okay, is your assessments. You have ICE tasks, which are your integrated curriculum engagement task. Your lecturers will do that during class time, or they will upload it on an iStars folder on ARC, and you have to then complete and submit them online. Okay. A minimum of 4 iStars must be completed for this semester, but please remember that as lecturers, we provide you as many iStars per learning unit to prepare you for your upcoming tests and exams. So we do encourage you to complete all your ICE tasks and not only focus on the 4, but 4 is the minimum number that is required in order for you to attain that 10%. Can you all see this 10% over here? That is how much you will get if you submit 4 ICE tasks. Okay, anything below 4, if you're submitting 3. So what happens is that if you submit less than 4, you're not going to attain the full 10%. Okay, so it's very, very important because again, this all contributes towards your CAS mark. Okay, um, even though you do not need to get a 40% CAS in order to qualify for the exam, it's very good to go into the exam with a good CAS mark. Okay, so if you're getting a CAS of 60% and above, it's just to your advantage. Okay, and having a 10% CAS already for submitting 4 iStars, which I think is possible for all students, would be great. And then your first test coming up now in test week, okay, will be your test 1. The weightage is 25%. It's a 1-hour test for 50 marks, closed books, and it will cover learning 1 to 3. The session that we have today, the catch-up session, is we will only look at learning unit 1 and 2 because I'm assuming that the lectures will only be starting learning unit 3 in the next week or so. Okay, and then test 2, which is the second in the second test week cycle, which is around about April, May, that will be covering learning unit 1 to 6. Again, 1 hour, 50 marks, and you can see now that the weightage has changed, okay, to a 30%, so it's a little bit more, okay. And then, of course, your exams, which the weightage is 35%, 3 hours for 150, and it's also closed book or learning units. Okay. All right. So I really do think that you can really score good marks for test 1 because learning unit 1, 2, and 3 is very theoretical. Um, the calculations that we will be doing is the calculations are more based on just the accounting equation, no real recording into journals. When we get to test 2, that is where we actually start now the real practical application with journals, ledgers, trial balance. Okay, so with test 1, I would really say you must really focus on doing well in this 3 learning units and in this test. Okay. Welcome, Pumulemo. From which campus are you? I'll just MSA. Okay, perfect. welcome. I'll just go back to the previous slide so that just you haven't missed much. It's just to tell you that please have a pen and paper ready for taking some notes. And if you do have your textbook and workbook, that would be wonderful, and a calculator because we will be doing some activities. Okay. And then I've just informed the students the importance of the VC student intranet. This is where you will also get not only your catch-up videos for the accounting module, but also for your PIMIC, your economics module. And if you want to download your past papers, okay, this is where you'll find it. Also, any other student material, the ARC student portal, this is your go-to. Okay, all right, your VC student intranet, and that you will get from your when you log into the VC website. Okay. Okay. Any questions regarding the past requirements and what your test will be? Will your upcoming test will consist of? Then you have your, I'll just highlight the dates for you again. The pairs will be updated because if you see what I've shared with you on the slides, does not include the written unseen exam. It says to be confirmed, but I'm sure that that will be released soon. So for now, test 1 is on the 28th of March. And then we have a deferred test. I'm not sure if you understand what is the deferred test. Would you like me to explain it to you?
Yes, please.
Okay, a deferred test this option will be used in the event that you are unable to write test one due to you maybe you sick on the day, okay, and now you're unable to come and write. You will then have to apply on the Student Hub to write the deferred test, okay, but when you do that application on the Student Hub, you have to submit your doctor's certificate because we need to have evidence. Okay, right. There are various other evidences that we do accept, but more specifically, it's when you are ill for that specific day and now you cannot write, and then you have another opportunity to right. Okay. So that is how the deferred test works. All good on your side?
Yes, thank you very much. I'm good.
Okay. Right. So those are the two dates, 28th of March for test 1 and 2nd of May for test 2. Okay, all at 8 o'clock. So please do see that you arrive early for your tests. Okay, because remember, it's 1 hour. The invigilator does not know you. It's not your lecturer, so they're not going to give you extra time. Okay, unless of course you have a concession, then you will be allowed additional time. But otherwise, if the test starts at 8, it will finish at 9. So to prevent yourself from not being able to finish on time, rather see that you are at the venue at 7:30 and on campus. Okay. I'm sure you are all aware that the learning management system that VC is using is ARC. Very important. I know many of you, because you've registered late, you still need to get yourself up and running with ARC. Hopefully this will be sorted out with the IT department and okay before your test commences, because most of the resources that your lecturer will be providing you to support you for your upcoming test, they will upload on ARC, and all your iStars will also be uploaded on ARC, and you also have to complete them on ARC. We have given students that have registered late, your dates will be extended, so please don't stress if you see that the due dates are already past. What you will do is the minute you get access into ARC is to now complete those outstanding ICE tasks. Okay. Do you all understand that? Even though the due dates are past, your lecturers will allow you still to submit those ICE tasks. Okay. Right. And I'm sure also that you will be receiving your training on how to navigate on ARC. So we'll start with Learning Unit 1. Okay, so Learning Unit 1 has 8 learning outcomes or objectives, which is very, very important for your upcoming tests because you will be assessed according to these learning outcomes. So we will look at the brief history of accounting, who uses the accounting information and what are the uses of accounting information, also to explain the principles of International Financial Reporting Standards, IFRS, illustrating the accounting cycle graphically, contrasting the difference between financial and management accounting, and also listing the various types of transactions that occur during the ordinary course of business. Okay, so these are the learning outcomes or objectives that we need to achieve for Learning Unit 1. I will just briefly, and I will just try to cover the most important learning outcomes, but please do remember that you have to go through whatever activities your lecturer has also noted is important for you to do for this learning unit because there is quite a few activities that you need to complete in your workbook. Okay, so let's see what is accounting. Welcome, Ryan. Welcome. And from which campus are you? Okay, so let's learn about what is accounting. Okay, is there anyone that maybe would like to share their thoughts before I share my answer? Okay, let's see. Accounting is often referred to as an international language of business, and this is the important thing you need to note here. Okay, it's the language of a business. Okay, right, but also very important to note is accounting is actually part of your everyday life. I'm sure you will see that even though we will be relating everything that we do into a business, you could also relate it to your actual personal life. Okay, all right. And it's financial information that is prepared for users all over the world, all over the world. Okay, all right. So it's an international language of business. So let's go back and let's look at the brief history of accounting. So I'm now in your textbook. For those who have textbooks, okay, we are on page 2 and 3. Okay, very important to note that Fra Luca Pacioli, he was known as the father of accounting, and he brought about the double entry accounting system. Okay, he did not invent it, but it was a method he used. And what is the double entry accounting system? for every debit entry, there should be a corresponding credit entry recorded in the books of the business. Okay. And Fra Luca Pacioli, in the Summa he published, okay, the ethics and cost accounting, and also he dedicated one section of his book to double entry accounting. Okay, and here more specifically, okay, not a problem, Ryan. If you have any questions, you can just post in your chat, in the chat. Okay. Okay, wonderful, Ryan. Welcome, welcome. Right, so um, then, so it's very important that you memorize this double entry. Okay, definition. For every debit entry, there should be a corresponding credit entry recorded in the books of the business. Okay, right. And like it says there in the textbook, okay, that on page 3, he used different accounts in his ledgers, and that is what we're going to look at now. So, accounting terms, assets, receivables, inventories, liabilities, capital, income, and expenses. Okay, that is the language of business. Though those are the terms that we will be using now going forward. Okay, all right. So again, what did Pacioli say? That a business needs to be successful. They must have sufficient cash or credit, a thorough bookkeeping system with detailed lists of transactions, and that is what you are going to be doing in this first semester. Okay, again, learning unit 1 and 2 and 3, lots of more theory. Um, we're just looking at the first 2 steps of the bookkeeping cycle, and then closer to learning unit 4, 5, 6, 7, 8, and 9, you will actually now do the proper bookkeeping, okay, and recording of transactions, okay. An accounting system which makes it easy for one to look at transactions very quickly and efficiently. Okay. Also, do take note that your textbook, even though we are actually going to be doing more manual accounting, you will also see that your textbook also reminds you, if you have a look in your textbook, the last page always takes you to computerized accounting facts, because you must know that even though we're using manual accounting here, that there are computerized accounting software packages out there. Okay, but in order to use those packages, you must understand the manual accounting. Okay, very important going forward. Okay, so just take note in your textbook, you will always see they are referring to computerized accounting facts. Very important on question 1.5. I'm not to share maybe what you can do if you want to see the slide more clearly. I think you are able to zoom it out. Are you able to see there on your side? But it's in your textbooks also, if you have your textbooks. This is just where Luca Pacioli is now explaining how he used the double entry system in the church, because he was doing the books of the church. But at the same time, he's telling us that this system can now be used also in businesses. Okay. Right, so if you go to page 295 in your textbook, this is where you actually now get a better understanding of the double entry system and how it has been modernized. Okay, so we are going to be focusing on this section, right? So he says that the sources of funds for businesses, firstly, is the contribution by the owner, so it's the capital. So what are they using that funds for? So you have application. Okay, so they're using the capital to purchase assets, okay, but that capital is not sufficient. So now what happens is the owner needs to get external financing in the form of loans. So where do they go to borrow? To borrow additional money? They will go to your financial institutions, your APSA, your FNB, your Capitec, Standard Bank, etc. And then they will apply for a loan. Okay? And then that additional funds will help them to run or pay for their expenses. And we get different expenses. You will see we will discuss that further on. But I'm sure you know that every business has operating expenses. Can you maybe mention a few that you know that a business should have and will have to pay? Michaela, Leandy, any answers from you, Ryan? Anything there that you can think of? There's no right or wrong, guys. We're all here to learn. Rent, yes. Yes, rent will be an expense if if you don't own a building and you now have to rent a premises in order to operate from. Okay, then that will be your monthly expense, your rent for your building. Okay, then further on now, the business needs to generate income because the aim of the business is to make a profit, but at the same time, the owner also want to benefit from the business and you'd like to take money out from the business for personal use, which is known as drawings. Okay, so income will then be generated through sales, which can either be cash or credit or services rendered. Okay, so what Luca Pacioli did is he now broke it down, or he highlighted certain words here: capital, your loans, that will be seen as a liability, and then we have income. So capital, liabilities, and income are seen as sources of funds, and then your assets, your expenses, and drawings are seen as application accounts. Okay, so this is very important now going forward, because when we're doing the double entry, we will be focusing on these accounts: assets, expenses, drawings, liabilities, income, and capital. Okay. And then he went further and he says, this is your double entry rules. So this is the mind map that you need to also study on page 47. Okay. It's in learning unit 2. Okay, but can you clearly see there what are the source, what are the source accounts, and what are your application accounts? Okay, sources again: capital, income, and liabilities. Okay, and here is your double entry. Okay, and what can you see that is similar to these accounts? Okay, right? On the T account, they all, apologies, they all increase on the credit side. Can you see that? Liabilities, income, and capital, all the source of fund accounts, they increase on the credit side, decrease on the debit side, and your application accounts are just the opposite. Can you see your assets, your drawings, and your expenses? What is happening here? They increase on the debit side and decrease on the credit side. Please, you need to remember this. Okay, so this is where your double entry uh, will will take effect when you are using your T accounts, and also when we will be analyzing transactions on our accounting equation, we will also want to know which accounts are we going to debit and which accounts are we going to credit, and that will be referring to those T accounts. And your T accounts are made up of assets. You will see we will go further in learning unit 2 to classify what are the different types of asset accounts. Okay, capital and drawings, you will see in Learning Unit 2, they have a special name for those accounts. And then income, we have different types of income accounts. Also in Learning Unit 2, we will look at what are those different types of accounts. Same with expenses, same with liabilities. Okay. Right. That is why I said Learning Unit 1 is so important, because this is your foundation now. You're being introduced to this, and as you are going to be going on, you will just be building on, building on, building on to this existing knowledge. Okay. Please just raise your hand if you do have any questions as we go along. Okay. Right. Now, who are the users of this accounting information? Who needs to know all this information? Okay. There are internal users and there are external users. Again, this is on page 4 and 5 in your textbook. Again, very important for short questions. Okay, they could ask you to list or name the users and explain them. So you must be able to name and explain. So the internal users are the owners, the employees, and the management. If you go to page 4 in your textbooks, you will see that. I'll just go through one of them. Why do employees need to have the accounting information? They are interested in the stability and the profitability of the employer that they are going to work for in the future or working for at present, and they're interested in information which enables them to assess the ability of the enterprise to provide remuneration, retirement benefits, and employment opportunities. Okay, so as employees, we need to know the accounting information, and more specifically, the accounting information they are referring to here is the financial statements. Okay, and usually your big companies, they disclose that information. So if you had to Google, for example, Mr. Price or Woolworths financial statements, you would see that they will be available there for you to have a look at and to see how the business has performed in the present year and past year. Okay. Then we also have external users. Why do they need our information? Our customers, our suppliers, and our trade creditors, our investors. If we're having a company and we're going to sell our shares, then we'll have investors. Government, more specifically, SARS. Why do they need our information? It's regarding tax policies. Customers, they are more interested in the continuance of the enterprise. They would like to remain loyal to you, so that they want to know certain information. The lenders also, before they borrow or loan money to you, they'd also like to see your financial information. Okay, your bank statements, for example, etc., etc. Okay, so these are your internal users and external users. Then, most importantly also, even though we have these users that need the accounting information, we also need to know why. Why do they need the information? And this is where we come to the uses of information. Okay, this is on page 5. Most importantly, they want to know, the users want to know, the owner wants to know, is this business making a profit or a loss? Okay, and we're going to look at that in Learning Unit 2, how we will calculate whether a business is making a profit or a loss. They also want to know how different departments are performing. Okay, is a department performing better than another, and the reason why? Okay, so that they could make changes or improvements. Okay, right. For example, if we're talking about different departments, here we are looking at um, bigger companies. Again, I will use Woolworths as an example, who has not only selling clothing, but they also have a grocery or food department. Okay, so it would be um, good for the owners there to see how the different departments are performing. Okay, right. So again, on page 5, there are more than this 4 that I've given you there. Again, is the cost of production reasonable or excessive? Here we are looking more at manufacturing businesses. Okay, if we're talking about cost of production, okay, is it reasonable? Is it excessive to produce a specific product that you are going to be selling? And then in the light of past performance, what improvements or changes can I make? Okay, so now you're looking at for example, like I've mentioned, with different departments, you can look, if one department is not doing well, what could you now do to make improvements or changes to that, to increase the sales of that specific department? Okay, so these are the different uses of accounting. Again, possible short questions, um, multiple choice, or you could be asked to actually name 2 or 3 uses of accounting. Okay, any questions? Okay, perfect. We will move on. Now, developments in the accounting field. We know that accounting is an international language, and therefore, okay, the bookkeepers and accountants have to when reporting, they need to report using IFRS. And what does IFRS stand for? International Financial Reporting Standards. Okay, and what are they? They are principle-based standards and interpretations, and represent the accounting framework issued by the IFRS Foundation and the IASB, which is the International Accounting Standard Board. Okay, so IFRS, what does it do? It provides a global business language, and it improves understandability and comparability of financial reports across international boundaries. Okay, and it is the dominant financial reporting framework which is being used worldwide at present. Okay, all right, so just please note that. Traditionally, we did use GAAP, which is GAAP, but going forward now, within South Africa also, we are focusing on IFRS as our reporting standards. So on page 7 in your textbooks, I did not share that, but it is very important that you look at the IFRS equivalent terminologies that we are using now going forward. Okay, all right, in your textbook on page 7. Then we have the characteristics that is important when we are presenting our financial statements. We need to ensure that these characteristics are taken into consideration. Okay, so we get fundamental and enhancing characteristics. This is on page 9 and 10 in your textbook. Again, you need to know this for um, multiple choice questions, or again, they could ask you to name and explain these characteristics. Okay, so what are the two fundamental characteristics? We have relevance and relevance. Materiality is a component of relevance. It means that whatever financial information or financial statements that the bookkeeper and accountant is going to be providing to the users, remember all those different stakeholders that I mentioned, or users, there are 8: the owners, the management, the customers, the employees. It must influence their economic decisions. Okay, right. So it's very important there for them. Okay, and then materiality, what do I mean there is that the information again that is going to be prepared by accountants, by the bookkeepers, must be free of um, there must be no omissions. Okay, the information must be relevant to this specific financial year. You will see in class now, and in the activities that you will be doing in class, your activities will always speak about a specific financial year, okay, or a specific month. So always remember, a financial year consists of 12 months. Okay, right? January to December, or 1st of March to end of February, all depending when that business started trading. Okay, that will be that business's beginning of its financial year. Okay. Right, and then faithful representation, again, freedom of error, whatever they are recording or presenting in the financial statements must be free of error. It must be honest. Okay, you have to be honest when you are presenting the information to the users. Do not put information there that you know does not exist in the business. Okay, so that is what they mean by faithful representation. And then under enhancing, we have 4. The information must be comparable. So we must be able to compare financial statements from over past and present. So we're always comparing to previous years and present years over time. Okay, so we can look if there are any trends in the performance and the financial position of the business. Okay, so it's very important that we are able to compare. So that is why when bookkeepers and accountants prepare information, accounting information, they will always look at the previous year. So it will be 2024, 2025. Okay. Understandable. Information must be presented in a way that is readily understandable by the users who have reasonable knowledge of business and economic activities. That is why you'll see we have certain layouts, certain structures of how things must be presented. Okay, and if the users look at that information, it would be easy for them to understand it. Okay. Timeliness must be provided within a specific time period, again, relevant to a specific financial year. And verifiability, okay. What we mean here is that we get a different independent observer, okay, that will then come and also produce the same financial results, because what will happen is that the same data and accounting policies will be given to this independent accountant. Okay, so you have like Mr. Price will have their own accountant doing their books, but they will get an independent observer to verify the information. Okay, so someone from outside, another independent accountant to see if that person will get the same results. Okay, so that is how the information will be verified. Any questions there? That is on page 9 and 10. And also to note that in this semester we will only be focusing on one specific business form, being the sole trader. Okay, so we will just be doing the books of a sole trader, even though we know that there are different other business forms like your partnerships, your companies, your close corporations. Those are the possible other forms of ownerships. But for semester 1, we will only be doing the books of a sole trader. Okay. Okay, so now we're going to look at what is the difference between financial accounting and management accounting, because these are the different fields in accounting. So again, there's your definition of what is accounting. It's all about recording, estimating, and organizing and summarizing our financial and operational data. Okay, so what does financial accounting entail? Okay, in your textbooks on page 16, you will see it's all about reporting to the stakeholders outside the organization, the owners, the lenders, SARS. Emphasis is on summaries of past events, very important here, past events. And with financial accounting, we are reporting for outside or outside the organization to those users, whereas for managerial accounting, it's for inside the organization. We report to the managers inside the organization. Okay. And emphasis will be on decisions affecting the future. So here we are looking at financial consequences of past activities. Here our emphasis is on decisions affecting the future. And then we emphasize on objectivity and verifiability. You remember those characteristics? Here our emphasis is on relevance, the characteristic relevance. Okay. And then for financial accounting, we're looking at the emphasis has to be on precision. The precision of information is required. And here it's on timeliness. That is the characteristic that is important for managerial accounting. And then emphasizes company-wide reports. So it's very important in financial accounting to provide and prepare financial statements for the users. And in managerial accounting, it's the focus is more on reports. Okay, providing segment reports. Okay, departmental reports. Okay, about customers, products, employees, etc. In financial accounting, the accountants and bookkeepers must follow IFRS. And with managerial accounting, they need not to follow a specific accounting framework. Okay. And then the last one, mandatory for external reporting, and then for managerial accounting, it's not mandatory. But if you look on page 16, it's very important to note that what the accountants will have to do is, even though reporting is completely voluntarily, they need to share this information, and in most instances, they are talking about notes, letters, memos, reports, and emails. That is how the information will be shared with the owners inside the organization. Okay. So again, can you see lots of theory that you need to know for Learning Unit 1? Because Learning Unit 1, again, lots of multiple choice questions and theory questions will come from this learning unit. So please note that your test will comprise of theory and practical. Okay. We also introduced here to the bookkeeping cycle, very important. Okay. Please do complete all the questions in Learning Unit 1. Some lovely multiple choice questions there. Question 1.3, 1.4. So please do complete those activities in your workbook. So let's look at the steps. There are 5 steps in the monthly bookkeeping cycle. Okay, so step number 1, transactions must take place within the business. Okay, then step number 2, the source documents summarize the transactions. Okay, my next slide, I'm going to go more into depth on the different types of transactions that can take place in a business. Okay, but step number 2, we have source documents that summarize the transactions. Again, let's just look. If when we go to Checkers, we are actually the customers, right? And when we are buying, we're filling our trolleys, we're going to the cashier now to pay. That is a cash sale transaction taking place there. Okay, and what happens at the end of the transaction? Okay, the customer makes a payment. I will make a payment either with my debit card or I will give the cashier cash. She will give me change. And what does she give me? What will she give me? She also gives me a slip. Okay, that's right. Thanks, Ryan. So I get a slip, okay, that is proof of my payment that I've paid for the goods, okay, and I can also see that everything is on there that I've purchased, but the business also has to keep an evidence of that transaction. Okay, so normally they have a cash register roll that is left behind in the cash register, and that is your source document. Those are the source documents that we are talking about, okay, or sorry, that we are referring to. Okay, but for every different transaction you will see going forward into Learning Unit 3, there are various source documents. Okay, so that is step number 2. So this is step number 1. Step number 2 is the source documents. Step number 3 now is what happens there is that the bookkeeper now needs to summarize all the similar source documents together. Okay, right? So all the similar source documents, because remember I told you there will be various source documents, so we will summarize the similar ones, okay, and then we're going to record specific source documents into specific journals, okay, and then the journal summarizes all the source documents, right, and that we will do in Learning Unit 4. And then step number 4, so now um, also, please take note that between step number 3 and 4, very important, I didn't put it in my little illustration over here, is that a bank reconciliation has to take place between step number 3 and 4. And that is what we will do more in detail in semester 2. Okay? Um, a business has to have a bank account, okay, which is known as a current account. So every month, the bank, whether it's Standard Bank or ABSA, will send the business a bank statement, okay? And now the bookkeeper needs to take that bank statement and compare it to the cash book receipts and cash book payments, okay? looking at the money that came into the business and money that has left the business. Because also remember that banks do make errors, but also to note that there will be transactions on that bank statement that we will have to then record, make additional supplementary entries into our cash book receipts and cash book payments. Okay, right, so very important there. Okay, so what is a general ledger? It just summarizes the journal. So this is where we're going to be using that double entry. For every debit entry, there must be a corresponding credit entry. So the general ledger is the T account. Okay, so here in our journals, we will total up. You will see when we get to learning unit 4, a journal is the definition, sorry, is on page 2022. The table used to tabulate and or summarize similar transactions. So we will have like the cash book receipts, and in there we will have a table with column headings. We will total up those columns and then we will post the totals to the ledger. Right, and then step number 5 is now that we need to prepare a trial balance, and the trial balance summarizes the general ledger. Okay, right. And then at the end of the financial year, this is part of the accounting cycle. So remember the bookkeeping cycle, which is a yearly cycle, is made up of both this monthly bookkeeping and what happens at the end of the year. And what do the accountants need to prepare at the end of the year? These are the two financial statements, very, very important. Statement of profit and loss and other comprehensive income, which summarizes the financial performance. Here we will calculate whether the business made a net profit or loss. And then they also need to prepare a statement of financial position, which measures the financial position. And this is what we're going to be focusing on. Okay, in learning unit 2, assets equals owner's equity plus liability. So it's actually based on your accounting equation. Okay, assets equal, so we look at what is the value of the total assets in the business, the owner's wealth, and its liabilities. Okay, and we will discuss that more in the next learning unit. Any questions there? Very important to note also before we wrapping up this learning unit is the definitions on page 21 and page 22 in your textbooks. What is a source document? What, again, possible theory questions and multiple choice questions. Okay. I'll just go back to the slide before this, sorry. These are the different transactions. Again, that is why I said this learning unit is so important, because here now they're explaining to you on page 22, sorry, not page 20 in yours, but page 22 in your textbooks, gives you a detailed breakdown of all the different transactions, the owner's contributions of cash or other valuable resources, the owner's withdrawals of cash or other valuable resources. So when we're talking about contributions here, we are talking about the owner's capital contribution to the business. The owner's withdrawals, we are talking about the owner's drawings, money that he's taking out of the business. Then we are looking at receipts from customers for cash sales. But we don't, in some businesses, we don't only sell for cash, we also sell for credit. So we have cash and credit sales. Okay, so just remember that, cash and credit sales. cash will go into the cash book receipts and credit sales into the debtors journal. And when we start selling on credit, okay, our customers or our credit customers, which are known as our debtors, now needs to pay us every month, 30 days later. Okay, so we do have payments that we need to record their monthly payment every month. That will go to cash book receipts. And if they return any goods that they are not happy with or they would like to exchange, that will go to our debtors allowance. So these are the additional transactions that affects credit sales. Payments from the debtors, returns from debtors. Okay. Can you still all hear me and able to see the slides I'm sharing? Can I just have a thumbs up? Perfect. Thank you, Michaela. Thank you. No questions. Thank you. All good. Thanks, Ryan. Right. Then we have cash purchase transactions. Okay. Right. That is when we paying via EFT. So the money is going directly off our account. Okay. And if we need to buy in bulk and we do not have sufficient cash, we would then have to open an account. Okay. And those suppliers now become known as our creditors. So now we have to record those credit transactions into a creditor's journal. And same like a debtor, we now have additional transactions. Okay. We've purchased, now we need to pay back every month. Okay, so those transactions again for payments will go into our cash book payments. And when we return goods to our suppliers or our creditors, it will go to our creditors allowances journal. So these are all the different transactions that take place in the business. Again, in Learning Unit 3, we will look at what are the source documents. In Learning Unit 2, we will be analyzing these transactions on the accounting equation. Okay, so in our next learning unit, you will see now I will be talking about the owner investing or contributing money to the business. So I'm talking about this transaction. The owners withdrawing money from the business. That is this transactions here. Okay. So are you ready for a quiz? Do you think you'll be able to name those, the 5 steps for me in the monthly book cycle? Name 4 different groups. I thought we could take a 5-minute break now. Are you happy to just maybe grab a cup of coffee or something cold to drink? Or would you like me to continue? It's entirely up to you. Michaela, Ryan, Leandi, Vuyu Wealthu, Mpumelelo, what would you want me to proceed?
I don't mind if we continue.
Okay, the proceed. Perfect. Thank you. I'm happy. Okay. So can I have some answers quickly? Please proceed. Perfect. Thank you. What are the 5 steps? Can you remember those steps I said? What is step number 1? Remember?
Transactions take place.
That's it. Transactions must take place. Okay. Then step number 2, we need to source
Source
documents,
document.
must summarize the transactions, and then it's your journals, then the general ledger, then the trial balance. Okay, right, and that is what we are actually going to be doing this semester. We're going to be taking the books up to trial balance. Okay, up to learning unit 4, learning unit 5. There, we will be doing this monthly bookkeeping cycle. Okay. Then 4 different groups of transactions. We just did that now in the previous slide. I hope you can remember that. Cash sale transactions, owners' contributions, owners' withdrawals, um, cash transactions, credit transactions, cash purchases, credit purchases, payments from customers, payments to suppliers. Okay. And then, of course, the difference between the statement of profit and loss and statement of financial position. What did I tell you? What is the key difference between the two? The one measures or the one summarizes the financial performance, and the statement of financial position measures the financial position, which is based on your accounting equation: assets equals owner's equity plus liabilities. Okay, and then you hopefully you have to go and study this now, so that if they ask you to tabulate forward differences between financial accounting and management accounting, you are able to do that. Okay. Okay, so we'll go to learning unit 2, and these are our learning objectives. Okay, learning unit 2 is based on the accounting equation, okay, and the double entry system. Okay, and by now I hope you know what the double entry system entails. For every, what is double entry? For every debit entry in the books of the business, there has to be a corresponding credit entry. Okay, all right. So just remember that. Very good, Mpumile. Every debit must have a credit. Okay. So our focus here is more specifically on the accounting equation. So we're going to look at analyzing transactions under the accounting equation. Definitions, very important. Okay. What is the definition of assets, non-current assets, current assets? What are your liabilities? And then we classify them further into non-current and current, and you must also be able to explain what is meant by a proprietary account. Okay, all right. So again, when we analyze the account on the accounting equation, assets, what are assets? What you own equal to your liabilities, what you owe, and equity is, okay, what you're going to get out. After you've put money into the business, your capital, okay, are you going to get a profit or are you going to be making a loss? Okay, so just remember that. And owner's equity equals, how do we calculate owner's equity? So remember, I just in the previous slide, I said assets equals owner's equity plus liability. But if I want to calculate the owner's wealth or owner's equity, then remember the formula will be assets minus liability. What I own minus what I owe. Okay, and that will then equal my net worth, owner's equity. There's a nice example on page 26 in your textbooks, where they say that Andrew owns a house and the house is worth 1 million. And then he mortgaged the house and he has an outstanding loan of 400,000 that is still owing to the bank. So Andrew owns an asset, which is the house, which is worth 1 million. He has debt or liability, what he owes, 400,000 is still outstanding on the home loan. So what is his net worth? We take the 1 million, we minus what he still owes, which is 400,000. So his net worth equals 600,000. Okay, so similarly as, and this relates to, and a person, an individual person, Andrew, but this can also be related to a business. Okay. So very important to note here are the definitions. Please, you need to study these formal IFRS definitions. What is income? What is expenses? What is assets? What is liabilities? And when we say formal IFRS, it means that you have to give it like it is in the textbook, which is we are a bit lenient with one or two words, but in actual fact, we want you to give it like it is there. Okay, because it's a formal IFRS definition. For example, on page 27, there where we ask, there's a definition of assets. It says an asset is a present economic resource that is controlled by the business as a result of past events. An economic resource is a right that has the potential to produce economic benefits. Okay, then that is the definition we expect you to give us in your test or exam. Okay. So let's look at the different classification of assets. We have non-current and current. And as your textbook says, current assets or non-current assets, firstly, are controlled or owned for longer than a year. That's important. Okay, so for longer than a year. Okay, so you're going to use it in the business for a longer period before you're going to dispose or sell it. Your equipment, your land, your buildings, your vehicles. Again, let's look at Spa, let's look at Checkers. Okay, when you walk into the Checkers and Spa, what do you see? Where are they storing all their cold products? Who can tell me? Or where are all the products that they are selling? Where are they packed on? Is it lying around in the store, or where do we find them? We find them in fridges, and they are on shelves. Well done. Thank you, Ryan. Yes, they are on we the cold fruits, the vegetables, the cool drinks, the meat products. They are all in fridges. So there are fridges. There are um, cash registers. There are shelves, and all that is equipment. So they've purchased it for the business, and they're going to use it for a very long time. Okay. What are current assets? Short term, and will be owned for less than a year. Okay. So you're going to use it up within a year. Your trading inventory, you're purchasing it with the intention that you are going to be selling it to your customers. Okay. Debtors, the same. You're selling to them on credit, but they must pay you back within a specific time period, within a year. Then you have money in the bank, okay? Money coming in, money going out. So the bank balance is um, changing all the time. Then you have petty cash. Petty cash, as your textbook mentioned there, petty cash is for to purchase small items, small items. For example, your staff refreshments. If you have a canteen and you'd like to purchase milk, tea, coffee for the staff, it will go out of petty cash. And I'm sure you all know what is cash float. You know what is cash float? The money in the cash register from which change will be given to the customer. Okay. So our cashiers in the morning, when they report to duty, they're always reporting with their cash float in their bags, which they're going to put into the cash register. Okay. Then you have input VAT. That is the VAT paid by the business to the suppliers on goods and services purchased by the business. And if you are a registered VAT vendor, then SARS allows you to claim back this input VAT. Okay. Any questions there with your non-current and current assets? Then we have two different types or classification of liabilities. They are your non-current and current. So that is your long-term liabilities, long-term debt, longer than a year. An example is your mortgage bonds or a long-term loan. And then your current liabilities, short term, could be owned for less than a year. It's your creditors again. Okay, you need to pay them back within a specific time period, within a year. You need to pay them back every month. And then if you go into a negative balance, a bank overdraft, this is when the bank allows you to go into a negative. So the bank has given you the facility to spend money that you do not have. Okay, so that is a bank overdraft. And then any money that is owing to SARS, the output VAT, that would then also be a current liability. So we get non-current assets and current assets, non-current liabilities and current liabilities. And if we total these two, if we add up this will make up your total liabilities, total assets of the business. Okay. And then very important. So you see, I tried to break down the accounting equation. So now you know when we're going to speak about assets, those are the accounts that we are looking for. Okay. If we talk about liabilities, those are the liabilities we are referring to. Non-current and current assets, non-current and current. Owner's equity. So what affects owner's equity on the accounting equation? Okay, your capital contribution, that will increase your owner's equity. That is the money that the owner used to start the business, and any income that the business makes, okay, through sales, through rent income, through commission income, interest on current account. And if the business made a profit, it will increase the wealth of the business. Okay. What decreases the owner's equity or the wealth of the business is your expenses. And you know every business must pay water and electricity. That is an expense. If they don't own property and have to rent their premises, they have to pay rent. So rent is an expense. The wages and salaries of the employees is an expense. And by now you know what is drawings, okay? Money that the owner takes out of the business for its own personal use. That decreases the wealth of the business or decreases owner's equity. Very important, okay, to remember this. Also, please study the business entity rule on page 33 and page 38. I'll just quickly go through it. What do we mean by the business entity rule? This is that the books of the business should not reflect the personal affairs of the owner outside of the business. That is what the business entity rule entails. Okay. It assumes that the books of the owner are drawn up to reflect only the wealth of the owner inside the business. What are your propriety accounts? The two propriety accounts are capital and drawings. Okay. The accounts that takes place between the business and its owner. So capital is when the sole proprietor makes contributions to the business, and drawings is when the sole proprietor makes withdrawals from the business. So those are the two accounts, capital and drawings. Everybody happy with these two statements on page 33 and propriety accounts on page 38? Okay, now we're moving on to what is profit, what are incomes, what are expenses. Okay, so we know that the main aim of any business, more specifically the sole trader, is that they want to make a profit. But now how are we going to calculate this profit? And we get two different types of profit. We get a gross profit and we get what is known as a net profit. Okay, so our gross profit is the profit that is made from when we are trading. And here is an example. So it's our net sales. We've made sales of over 1 million, but we had also some sale returns, so we need to subtract that, and now we get to our net sales. Okay, right. And then we take our net sales and we minus it from our cost of sales or cost of goods sold, and that equals our gross profit. So just remember that sales, net sales minus cost of sales equals gross profit. So that is the profit made from trading. Okay, when you bought your merchandise or your inventory, okay, then you added your profit markup to it to get to your selling price, and now you took your selling price or your sales and you subtracted it from your cost of sales, and that two amounts will then give you your gross profit. What are incomes? What are expenses? This is all on page 40 to 41 in your textbooks with all the different examples. Incomes are sales, services rendered, rent income, interest on fixed deposit, interest on current account, and commission received. And all your different expenses, we have cost of sales, rent expense, interest expense, rates and taxes, like I mentioned, water and electricity, wages, stationery, packing material. There's many other examples in your textbook. Okay. I'm sure you've seen that I've mentioned something very important here, which is cost of sales. Okay, so there I've just given you the formula of how to calculate gross profit, sales minus cost of sales. But Michaela, if you have a textbook, if you can go to page 41 in your textbooks, the others, please just note that cost of sales is the expense that is incurred when trading inventory previously purchased is sold. Okay, so we purchase trading inventory for our business, okay, right, with the intention that we are going to sell it to our customers. And um, the minute the trading inventory gets sold, then in the books of the business, it is seen as an expense. Okay, so when this trading inventory is sold, the asset is expensed. And it's expensed to this account known as cost of sales. So cost of sales is the expense incurred when trading inventory previously purchased is sold. Okay. Right. So just remember that. What is net profit? It is the profit that is earned after all other expenses and all other income have been taken into account. So this is your final profit. After you've earned additional incomes, like I've mentioned, those examples, and then you've paid for all your expenses for the month, then what is left, that is your net profit. That is the profit that the owner will either invest further into the business or will use maybe to expand his business, etc., etc. Okay. I've also given you a little thing that you can use. GP stands for gross profit, plus other income equals your net income minus your operating expenses equals your net profit. And then very important for learning unit 2 is page 53. Okay, even though as I've gone through the textbook now, I've told you that there are examples there also given, but please, you need to study this chart of accounts. Going forward into learning unit 3, 4, 5, 6, it's so, so important. But more specifically for what we're going to be doing next, analyzing transactions on the accounting equation. It's so important for you to know your chart of accounts. If you're not able to know that machinery, equipment, furniture, vehicles is an asset, you are then going to analyze the transaction or show the impact of the transaction incorrectly. Okay, analyze and show the impact incorrectly. Okay, so it's very important, please, that you do study page 53 very, very well. Okay, for the test and for your exams. So you can see nicely here, non-current, current. Look under owner's equity. Okay, the two propriety accounts, capital we know increases the owner's equity. And what do we know about drawings? It decreases owner's equity. And what do we know about income? Also a plus, and expenses decreases owner's equity. Okay, and then your liabilities. Right. So we're going to do an activity now. Okay, this is similar to question 2.4 in your textbook. Okay, again, also remember this that in your tests and exams, we cannot ask you to do all the calculations as in question 2.4 because of time. Remember, your test is only 1 hour for 50 marks. Okay, so here we have a question. They say below is an extract from the books of Fern Traders on 31st December. So they've given us, these were the balances for, this is how much money they had in the bank, but it's an unfavorable bank balance, okay? Then they gave us the debtors control balance, creditors control, inventory, loan, VAT, output, VAT input, capital drawings, and the profit for the year. So again, what do you see here? In order to answer a question like this, you need to know your chart of accounts, okay? Because I'm asking you now to calculate what are the current assets, okay? So you need to know what are current assets. If you go to your chart of accounts, which ones are the current assets? Who can tell me? Is bank unfavorable a current asset? No, it will be a liability. It's the same as bank overdraft. Okay, so the only current assets here will be your debtors control, your trading, inventory, and your input VAT. Those three amounts will be your current assets. Okay, all right. Then the next question. So I hope you already totaling up your answers for me there. So we have 20,000, we have 21,000 for inventory, and we have 800 for input VAT. So those three amounts. Okay, so on your calculators and on your notepad, you can add up that amount for me. I will be sharing my answers soon, and we'll check if yours and mine are correct. Then our total liabilities. Okay, so here we say total. We did not only say non-current and current. Here we are now requesting that you must give us both the total of the non-current plus the current, and then we add it together. Okay, so for for non-current, the only one that we have is loan. Do you agree with me? Are you happy with that amount? It's only the loan that will be non-current. Okay. Have page 53 open on your textbooks if you need assistance and you can't remember. And then for current liabilities, it will be the bank overdraft amount, the creditors control, and the VAT output. Okay. It will be this one, this one, this one for current, and then this one for non-current. And that four amounts will give us the total of the liabilities. Are you ready for me to share my answer? Okay. Okay, so what answer do you have for current assets and for total liabilities? Let's see. Michaela, Ryan, who's got an answer for me? Okay, Ryan says 41,800. Anybody else? Perfect. Mpulele. That's correct. Well done. Well done. Okay, so it's your debtors control, your inventory, and your VAT input. Okay, so that gives you that total. And then your liabilities. See, sorry, liabilities. It's your non-current plus your current liabilities. Did you get to that answer, Ryan and Mpumulelu and Michaela? Are you happy with that 59,000? Perfect. Thank you. Yes, perfect. Thank you. Right. You can really do well in this question, students. You just need to study your chart of accounts. Okay. Because if you choose or if you had to put the loan now under assets, then clearly your answer will not be correct. But also do remember, in accounting, very, very important is to show us how you got your answer. So can you see what I did here? I'm telling you that I'm going to take the loan amount plus that amount, that and that and that. So you must show me your workings. Please don't just go write an answer. Okay, if you just say 59,000 or you write 58,000, for example, now I have to mark it wrong. Okay, because 58 is not the correct answer. But maybe what you did is you forgot to add the VAT output. But if you had to show me how you got to the answer, I would then give you method marks for the workings. We call them workings. So it's very important in accounting to always show your workings, show your workings. So I need to know, how did you get to that 59,000? Okay. Right, so at least you can get part marks instead of losing all the marks. Okay, instead of getting a 0, you can still at least get a half a mark or 1 mark for this question. Okay, then owner's equity. Okay, so there's two ways in which you can calculate owner's equity. Very important. These are the two formulas: assets minus liabilities. We did that example where I showed you with Andrew, and he owns a house worth 1 million and he owes the bank 400,000. So what is his net worth? It was 600,000. Assets minus liabilities. But in this exercise, if I just quickly go back to the slide, they want us to calculate owner's equity, but they also told us that they did not include all the assets and liabilities. That is why that should give you a hint that you cannot use that formula assets minus liabilities. But what can you see that they have given you here? They've given you capital, they've given you drawings, and they've given you the net profit for the year. Okay, right? So now you can calculate the owner's equity using that. Okay. Also very important to note, how did they get to this net profit? Okay. It was the total income that they made. Okay. They took their total income from the sales to adding all the other incomes that they made, and they minus it from their total expenses, and that gave them the final net profit. Okay, so always remember, profit is made up of your total incomes minus your total expenses, or like I shared in the earlier slide, it is your sales minus your cost of sales. You get your gross profit. You add your other incomes. You minus your total operating expenses, and that will give you your final net profit. Okay. And then you minus the drawings. Okay. So are you all happy with that answer? So his owner's equity is worth 18,000. Are you happy with that answer? Perfect. Okay, if you want to practice more, question 2.4 is the only one at the beginning of the textbook, but we do have other revision questions. Okay, they are on page 471 to 485. Please do work through that at the back of your textbook. Okay, so you'll practice it in your workbook, and then if you want to check your answers, you'll be able to also get that at the back of your textbook. Okay, but please do revise that. Okay, we're not sure which type of questions will come up in the test, so we have to prepare for this type of question and the one that we will be doing now also, the analyzing transactions on the accounting equation. Okay, so before we practice an activity together, I want us first to please remember these steps. When you are going to be analyzing transactions on the accounting equation, first read the transaction with understanding. Okay. Then you identify a minimum of two accounts. Okay, so you're either going to say capital bank, trading inventory bank. Okay, that is what there must be, you must, or it could be an expense account, wages bank, stationery bank. Okay, but certain words will also guide you as to know what are the two accounts. Okay, then you have to classify them. Okay, so if you said bank, you must know bank must go to assets. If you say wages, you know wages must go to owners, equity. Why? What is wages? Wages is an expense, and we know that expenses, good, Ryan, and we know what does expenses do, Ryan? They decrease owners equity. Okay, right, so you just need to remember that. So that is step number 3. Now step number 4 is to establish the impact of this. Okay, is it an increase or is it a decrease? And then lastly is to check that your equation is in balance, in equilibrium, meaning that your left-hand side must equal your right-hand side. The left-hand side must equal the right-hand side of your equation. Okay. Left-hand side, sorry about that. Left-hand side must equal the right-hand side. So the equation must balance. So please just now, when we're going to practice an exercise, one or two transactions together, I need you to remember this 5 steps. Will you be able to remember this? Thank you. Thank you. Right. Again, please study this. Okay? Right? Assets increase on the left-hand side with a debit, so that's a plus. Decrease on the right-hand side with a minus. Owner's equity increases on the credit side or right-hand side with a plus. And what increases owner's equity? Capital and income transactions. What decreases owner's equity? Drawings and expenses. Your expenses. Okay. What increases your liabilities? They will increase on the credit side, decrease on the debit side. Okay, Ryan, you're asking me, sorry. Okay, Ryan, let's just go look at that again. Okay, you remember when I told you, now I'm taking you back to learning unit 1. What did Luca Pacioli classify assets as? An application. So application accounts increase on the debit side, decrease on the credit side. Just remember that. And sources of funds, accounts, liabilities, they increase on the credit side, decrease on the debit side. Now, owner's equity is also, we know that capital is a source of fund account, and drawings we know is an application account. But here, Ryan, we're looking specifically at the impact the drawings and the expenses and the capital and the income has on owner's equity. So even though in the previous slide I told you that that double entry of application and sources, we will use that whenever we do the T accounts. Okay? But when we're going to look at analyzing transactions on the accounting equation, you need to remember that the wealth of the owner or owner's equity is impacted by these 4 transactions. Okay? And the capital that he puts into the business will increase the wealth, the income will increase the wealth, the drawings, okay, decreases the wealth of the owner, and the expenses will decrease the wealth of the owner. Okay, all right, so just remember that this comes from that mind map that I showed you earlier in learning unit 1 for your double entry rules. For every debit entry, there has to be a corresponding credit entry, but you need to remember that when you're going to show the impact of drawings on owner's equity, you have to show a minus sign and not a plus sign. Does that maybe answer your question there, Ryan? Okay, perfect. Thank you. Okay, so let's look at an example here. We have they show you how you need to answer the question, and this is very important in your upcoming test and exam. Okay, we will always give you an example of how you need to answer the question. So you will get an answer book for your accounting upcoming test and exam, and we will give you first an example transaction, and then we will show you this is how you need to answer it. It's a little bit different from the exercise that is in the textbook from question 2.9. In question 2.9, we showed the transaction of the double entry of account debit and credit underneath here. Okay, but in the test and or exam, they could ask it separately in its own columns. Okay, account debit, account credit, and then you have to show the impact on the assets and owner's equity and liabilities. Okay. So the first one was with the owner deposit the 500,000. So the double entry was debit the bank. Okay, so clearly you can see, I always tell this, and now in the test or exams, you are allowed to write on your question paper. So now you can draw a line under bank, and the minute you see owner deposited, then you know this account's name is capital. So there's your two accounts, capital and bank. Okay. And then, so there's step number one, read the transaction. Step number two, identify minimum of two accounts. Step number three, now you have to classify them. So bank, you know, is asset. So you're going to go and put the amount under assets, and owner's equity, you know, affects, I mean capital, sorry, affects owner's equity. So that amount has to go there. Okay. And now you need to determine if it's a debit or a credit. And this is what's going to help you. Okay. If I if you can just remember to write this on your answer book, okay? Anywhere there on your answer book or on your question paper, memorize this and remember to write it there. It will help you, okay? To know when to debit and when to credit and when to use the plus or the minus. Okay, so again, read the transaction. The owner deposited money into the bank, okay, for capital contribution. So we know it's capital and bank. Okay, so clearly already, what do you see here? Where do you see capital here? Capital is under credit. Can you see that? Okay, so now you know that you have to credit capital, so the other account needs to be a debit. So you're going to have to debit the bank account. And if you debit the bank account, what is the impact? It's a plus. So both of them will be pluses. Can you see that, everybody? How this can help you to know when it's a debit or a credit, and whether you must put the impact or the effect as a plus or a minus. Okay. So there it's debit the bank, credit capital, plus 500,000, plus 500,000. Let's look at the next one. The owner donated his own vehicle to the business worth 250,000. So again, read with understanding the transaction firstly, and then you identify two accounts. Okay, so can you tell me what are the two accounts there? I'll give you a few minutes. Okay, Mpumelelo says vehicles, but why are you crediting the vehicles? But vehicles is correct. I just want the name of the two accounts. Okay. The owner is donating. The owner is donating his own vehicle. So the minute you see the word owner, it's not saying now deposit, but they're saying capital. Very good. So it's going to be capital and vehicles. That is the two accounts, capital and vehicle. Okay, right? Just identify that. So it's assets and owner's equity, step number 3 now. Now I classify. Capital will go to owner's equity, vehicle will go to assets. Now the next step is to see what is the debit or credit. So I go back here. It's again capital. So clearly I know capital. If it's here on the credit side or on the right hand side, I must credit it. And we know that vehicle is an asset. What is happening to that asset account? Okay, it's coming into the business, so the value of that account is increasing. Okay, so that is why I also need to debit assets. Debit assets or debit vehicles, credit capital. Debit vehicle, credit capital. That will be my double entry there. Everybody happy with that? So it's again a plus and a plus. Okay, can you see the debit vehicles, credit capital, plus, plus. Let's look at the next one. We purchase inventory for cash. Read to understand. So we're buying inventory for our business. Okay, we need to buy now. We've already deposited. We've got our capital. We've got our vehicles. We need to now buy stock because we need to start trading to sell. So we went and we bought cash inventory worth 50,000. What are the two accounts now? Underline that or highlight it or draw a circle. Michaela, Leandy, what do you think? What are the two accounts there? That is inventory. Okay, good. Ryan. Okay, Ryan, cash. Whenever you see cash, when it's bank, yes. Whenever you see the word cash, Ryan, then remember it's money coming out of the business's bank account. So they won't say purchase inventory and for bank. Are you with me? Or out of the bank account. They will always say for cash or via EFT. So when they say cash or via EFT, you must know it's coming out of the bank account. If you go to your chart of accounts, you'll see we don't have an account account name as cash. The account name is bank. Okay, bank, bank. So the two accounts is inventory. Okay, and then for cash that will be bank. Okay, so now we know. Now we have to classify them. What does the chart of accounts say? Inventory and bank are both, what are they on the chart of accounts? What is inventory and bank? You can unmute your mics, guys. They are both good. They are both assets. Very good. Okay, so you see it's a little bit different now from number 1 and 2. Both, yes, Michaela, correct. They are both current assets. Both
Hello.
current. They are both current assets. Okay. Right. So which means one asset will increase and the other asset will decrease. Okay. Ryan, what do you think? Which one will we debit and which one will we credit?
Do we credit inventory? Hello?
Hello, inventory. Just think again. Just think again, Ryan. You purchase the inventory, okay, for cash. So the inventory is coming into the business, and out of the bank account, money is leaving. So again, just look here. If we're increasing the value of a trading inventory now, we've got an account named trading inventory. So that value of the trading inventory will be increasing. So what do you think the double entry will be? Because we're purchasing trading inventory.
So the bank is minus, it decreases.
That's it, because money is going out. So bank will be credited. So the other account will be debited. And what will be that account's name? Trading inventory or inventory. Okay, so there's your debit and credit. Debit trading inventory, credit the bank. Okay, right, inventory bank, plus minus. So inventory will be the one that increases and bank will be the one that decreases. Okay.
Sorry,
Yes.
what exactly does it mean when your owner's equity is credited? Like what does crediting mean and debiting mean?
Okay, yeah. Okay. Remember, are you worried about this year?
Yeah, like I
Okay.
don't quite sorry, I don't quite
Okay. Okay. Maybe I need to explain to you uh with T accounts or with accounting, a debit and a credit is a left-hand side and a right-hand side. Okay, sorry, that is on page. They explain to you what the debit and credit means. It means left-hand side and right-hand side of an account. So that is your debit and credit. It's on the left-hand side or on the right-hand side. Mm, let me just take you to that. Um, sorry there. The definitions of debit and credit. So when we put it on the so the right hand side, it's just remember it's right is credit and or should I say, sorry, why can't I find the page number now?
46, page
Is it
46.
is it on page 46? No,
Yeah.
sorry. There we go. There we go. Yes. Debit quite simply mean left. It's the left-hand side of an account, and the credit is the right-hand side. Now, if you go further, you'll see there they explain that to you again on page 46. You see the infamous rules of double entry. And double entry came about with the sources of funds and the application of funds. Okay, because if you looked at what I shared with you right earlier on, with Luca Pacioli, you would see that he when he drew that comparison, it also had a left-hand side and a right-hand side. Can you see what he did? On the right-hand side was all the sources of funds, and on the left-hand side was all the application of funds. If you go to um, 55. Okay, so on page 295, you'll also see there when he's trying, no problem, Michaela, no problem. So when you see on page 295 there, Ryan, you'll see also how he actually explains it is how it's also presented. Can you see? The sources, the liabilities and income is on the right-hand side, which becomes the credit side, and the application accounts are on the left-hand side. He didn't put it like other way around. So you're actually trying to tell you that that is how it should be. Okay, your sources of funds must be on the left-hand side, which is your credit side, and your applications are on the left-hand side, which is your debit side. And then he actually shows it on page 296. That is how the double entry rule then applies. Okay.
So I just want to get something. So if I'm purchasing something,
Mm-hmm.
I am making the purchase, so I'm debiting it off my account. And as the owner, they are getting my money on credit.
No, no, no.
No.
Remember, you are doing this from the perspective of the business. You're doing the books of the business. And remember now, this is coming into the business. The owner, okay, so you remember the first transaction, he contributed money to his business. So that is going now into the bank. The money is going into his bank account of the business. Right? Now he is going to purchase of that 500,000 he's going to use now and pay 50,000 out of that now for his inventory. Okay. That is what's happening there with that transaction. Because you see, where did that 500,000 go? It's affecting bank. Okay. Right? So now he needs to buy stock for the business. So money is going out of the bank account, but for inventory. So inventory is coming into the business. So now we have to open up an account name as inventory. And according to the double entry rule of Pacioli, because the inventory is an asset and the value of that asset is increasing, we need to debit that asset. Okay, inventory. So don't see it from a perspective of you and the business. See it as a perspective as you, the bookkeeper, and doing the books of the business. Maybe I can explain it like that. Maybe it would be better. So the business is receiving this inventory now. So the value of that trading inventory account must increase. It can't decrease. The only time it will decrease, you'll see, is when we're going to sell the goods. Then the value of it will decrease of trading inventory.
Okay. I
Okay.
think I'm getting it. Yeah.
Yeah, so you just need to remember debit is the left-hand side, but left-hand side also is the plus side, and credit is the right-hand side, but also shows the minus. Minus, okay, for assets. And just remember assets and liabilities, it's opposites or vice versa, okay, not the same. Okay, right, so let's do the next transaction. So now it's not on, now we're purchasing again, maybe we need to buy in bulk, so we don't have money or sufficient money to do a cash purchase, so we decided to buy on credit now. So what do we call those suppliers that we owe money to? They are known as your creditors. Yes, well done, Mpumelelo, well done. Okay, so now the two accounts is inventory and creditors. Okay, so what is inventory? I classify inventory under, where am I going to, under assets, right? And creditors is a liability, so that we will classify. So now the first thing you will do is, I always tell the students, first write down the amounts. So you'll first put down the 45,000 here, and you'll write down the 45,000 under assets and liabilities, okay? And now you can decide what is the double entry and whether they will be pluses or minuses. Okay, so again, now you go back here. Okay, this will help you. Creditors, You owe your creditors money. So what do you think is happening to your liability account, Ryan? Do you think it's decreasing or increasing? Because you're buying now, so you owe them.
It will increase.
That's it. So clearly creditors has to be credited, which means that the other account, which is inventory, has to be debited. Can you see? So if you identify the one, then you know that the other one has to be a debit, can't be a credit. Okay, because the double entry is for every debit entry, there has to be a corresponding credit entry. So we're going to debit inventory and we're going to credit creditors control. Okay, and always remember, again, your left-hand side must equal your right-hand side. The equation must be in balance, in balance, in balance. Plus 45,000 equals plus 45,000. Again, well, what do you see that you need to know here is your chart of accounts. Again, you see how important is the chart of accounts? Okay. All right, page 53. You need to study page 53. Okay, now we've bought, we've got enough stock. We need to start selling. So the customers came into the business and they bought goods. Okay, so but the transaction says sell goods. So we sold goods, but we sold it on credit. So now it doesn't say credit sales. If it says credit sales, immediately we would know it's debtors and sales. But now it they try to explain it more to you by saying that we're selling goods on credit. So you must assume that that is credit sales. Are you with me? When you see a transaction like that, sell goods on credit, immediately it must click as credit sales, credit sales. So what do we call those individuals that owe the business money? What are they known as?
Debtors.
Debtors. Very good. So now we have debtors as our one account and we have sales as the other account. So there's the two accounts. Okay. So we've identified the two accounts, debtors and sales. Now you go to your chart of accounts. Now you have to classify them. Where do debtors go and where do sales go on the chart of accounts? Where do you see debtors and sales?
Debtors is a current asset.
That's it. So it's going to go under assets. That's correct. And then we have sales. Where will sales go?
Owner's equity.
Owner's equity. Very good. Okay. So now you have your two accounts and you know the classification is assets and owner's equity. Now you can do your impact. Okay. Right. What did we say is debtors? Debtors is an asset. What is sales to the business? Michaela, Leandy, Ryan. What is sales to the business? It's an
Income.
income. That's it. So incomes, again, if you look at here, where's income? On the right-hand side. And the right-hand side says that income must be credited. Okay, there we go. Owner's equity. All right. So we're going to credit sales. So that is the account we need to credit. Please remember, you must not write down the classification. Are you with me? Please don't make that mistake. Don't write down the classification. You must write down the account's name. Remember, assets, expenses, income, liabilities are the classifications, okay, or the elements, okay, of the accounts. All right? So you must remember now, when you say credit, you have to say credit sales. You must not write income. And you must say debit, debtors control, not assets. Assets is just the classification for you to know where to show the impact on the accounting equation. Okay, so please don't get confused with what to write. We don't write the element, or we don't write the name of the classification, but we write down the name of the accounts here. Debit, debtors control, credit sales, and then debtors is an asset. We only use the classification so that we know that the impact has to be for assets, and sales impacts owner's equity because it's an income. Okay. Everybody happy with that? Will you be able to remember that? Please don't write income, don't write assets as your account debit, credit. You need to write the actual account's name. Okay. Okay. All right. But it does not. With this transaction, there is a second part. Okay. All right. Because if you take note, we sold it on credit. There's a selling price. We all know that the main aim of the business is to make a profit. So we went and we bought the goods, and we're now selling it at the selling price. And they told us that the cost price was 30,000 and the selling price was 45,000. So clearly, how much profit did this business make on this sale? Who can tell me? How much was the gross profit?
15,000.
15,000. That's correct. You made a profit of 15,000 on that sale. Okay? So selling price minus cost price is the same as sales minus cost of sales equals your gross profit. Okay, now so the first part of the transaction is to record the sale or the income, but now we also need to show in the books of the business that the stock has left. Okay, the customer has left the store, paid for it, and now has left the store, but we don't have it anymore. So in the books of the business, we need to show that the stock has left. And remember, I gave you the definition of what is cost of sales. We need to show that cost of sales is an expense. So in the books of the business, the double entry will be debit cost of sales, credit trading inventory. Remember, they said when the inventory is sold, it is then seen as an expense. Okay, as an expense. So, and it must leave or the recording in the books of the business is to show that the stock has left at the cost price. Please note that. Okay, so that is why that is so important, the cost price. So the double entry now will be, or the two accounts will be cost of sales and trading inventory. And on the chart of accounts, what is cost of sales? It's an expense, and what do you know? What does expenses do?
Decreases owner's equity.
That's it. So it decreases owner's equity. So we're going to debit. We have to debit the expense account because it decreases owner's equity. So we're going to say debit cost of sales, and we can't debit trading inventory. We know that the other account has to be a credit. Okay. For every debit entry, there must be a corresponding credit entry. So the credit entry will be for trading inventory. Okay, so just remember that. Debit cost of sales, credit, trading inventory. So trading inventory will decrease, and now they are both minuses. Both minuses. Okay, that's your impact. Both a minus. Okay, it will take a bit of practice. That is why you need to. Learning Unit 2 has many exercises. Okay, 2.5, 2.9, 2.7, 2.11, 12. Yeah, lots of exercises to practice this double entry. Okay,
Sorry, can I just check something?
yes. Yeah, at the solution, Ryan, or at the actual questionnaire? What do you like to check? Okay, okay, Ryan. Once you're ready, we'll go back, but we'll continue now. Now I want you to look at the transaction here, the next one. Can you all see? Little bit different. We're still selling goods now, but not for credit, but for cash. And what did we say? The minute we see cash, what do we think on which account? What is that account's name?
Bank.
Bank. Very good, very good. Mpumelelo, it becomes bank. Okay, bank. All right. So now the double entry will be for which two accounts? We know the one is bank. And what is the other account's name? Exactly the same as 5A. Sales. Very good. It's bank and sales. That's correct. So again, we have, now we classify them. Okay. We know those are the two accounts, bank and sales. Okay, so that will be our two double entry accounts. One has to be debited, one has to be credited. But you already know that from 5A. What did we do with sales? It's an income. So income, it increases owner's equity. So we have to credit sales. So we then, because we're crediting sales, the other account has to be a debit, and that is why we are going to debit the bank. Debit the bank, credit sales. So can you see when you identify the one already, you know that sales is an income, so you have to credit that account. So naturally, the other account must be a debit. Okay, debit. And if it's a debit, it will be a plus. So they both will be pluses. Both will be pluses. Okay. Debit the bank, credit sales. And there you have it. Plus, 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 plus. Okay. And then the other exactly the same as that one. Okay. When you've sold the stock, it's treated as an expense. So in the books of the business, you now have to record the stock as leaving at the cost price. So debit cost of sales, credit trading inventory. So you do that same entry there. Okay. We're just going to do another trans 2 because they're a little bit different now. And we're looking at an expense, paid wages. Okay, here they said from the bank. Okay. Normally they would say you just paid wages or paid via EFT. So this one was easy. We know the two accounts is wages and bank. What is wages? An expense. Okay. And bank is an asset. So it's expense and asset. Okay. All right. So we know we're going to write that 120,000 under assets and under owner's equity because expenses decreases owner's equity. Okay. Again, now you go back to this. Right. expenses there, your minus, where is it? On the left-hand side, and your left-hand side is your debit. So you're going to debit wages because it's an expense, and you're going to credit the bank. Okay, so there it shows you. Both of them will be a minus because the debit side is a minus here, and on the assets, if you credit it, it's also a minus. Okay, minus, 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 minus. Left-hand side equal right-hand side. This one is interesting. I want you to have a look at the one on the 8th. It's stationery on credit. Okay, so stationery is an expense. So clearly we know that amount will go here to equity, and we're buying it on credit. So we owe money to our creditors. So that 1,500 will go to the liabilities. Okay, right. But one of them will be a plus and the other one must be a minus. Why can't they both be pluses? Can someone tell me? Why won't they both be pluses? If we make them both a plus, then the equation won't balance. Can you see that? If I have to make this plus 1,500 plus 1,500, then my right-hand side will equal 3,000, and this will be 0, which means it's not correct. But because this is a minus 1,5 plus 1,5, then it also comes to a 0. So my left-hand side must equal my right-hand side. Do you all understand that? Can you see now why you have to do that last step? You have to check that your equation balances. Okay. So stationery will decrease owner's equity, and creditors is increasing because I bought from my creditor. So my balance on that account will increase. Okay. Any questions there with the accounting equation? I know it's a lot to remember, but it's just going to take practice. You have to go and practice. Okay. And of course, also try to memorize and study this. And of course, the chart of accounts. If you don't know your chart of accounts, you are going to be classifying your accounts wrong. Okay, on your accounting equation. Okay. So now we're going to go a bit further where in this exercise, okay, I gave you both the selling price and the cost price. Okay. But you'll see as we progress, they're only going to give us the selling price and not the cost price. Ryan, can you mute your mic for me, please?
Oh, sorry.
Sorry, it's just scratching. Okay, so what will happen now is they're going to give us a scenario where they're going to tell us that this is the business, they're using the perpetual inventory system, and they have a markup. This is how much profit they are making on the goods that they are selling. 50%, 20%, 30%. So now we are expected to calculate this missing figure, which is the cost price. Okay, so this is what we're going to be doing in the next slides. Okay, so firstly, this was the easy one where they gave us both selling and cost. Now we will give you selling and ask you to calculate cost, or we could give you the cost price and ask you to calculate the selling price. You must be able to do both. Okay. All right. So if you go to question 2.10, you'll see that what is this markup? Markup is a profit expressed as a percentage of the cost price. And how do they get to that? Okay, how do you get to profit? You know that selling price minus cost price equals gross profit. So if you want to know what is your markup percentage, your formula is you're going to take the gross profit and divide it by the cost price, multiplied by 100, and that will give you your markup percentage. Okay, so here's an example. The selling price was 25 Rand, the cost price was 20 Rand, and the profit was 5 Rand. Okay, so what is the formula? Profit over cost. So I'm going to say 5 divided by 20 multiplied by 100, and now I can get my markup percentage. Okay, but remember, not all businesses do markup on cost. We have some of them that also use a gross margin percentage, which is also known as markup on selling. Okay, so what is that? A definition there or explanation for gross margin? It's a profit expressed as a percentage of the selling price. Okay, we're just taking two amounts and we're expressing them as a percentage by dividing. Remember, whenever you express amounts as percentages, always remember you need to divide and multiply by 100. Okay, so again we're going to take your gross profit divided now by the selling price. Okay, so when it's gross margin, it's selling, and when it's markup, it's cost price. Okay, gross margin, selling price. So again, the same example. Selling price was 25, cost was 20, so you made a profit of 5. But now the formula says profit divided by selling. So 5 divided by 25 times 100. So he made a a gross margin percentage is 20%. That's the profit percentage, 20%. Okay. So just remember this. We're also going to do this in Learning Unit 3. Your lecture will also do this again more in detail, and you're practicing this calculations more in Learning Unit 3 also. Okay, but now let's look at the scenario that I was speaking about. How to calculate the cost of sales. Refer to question 2.11 and 2.12. They're giving you the markup now, okay? They're saying markup is 50% on cost, or they will say markup is 20% on selling, right? So then, please, again, you have to try and remember this method. Cost price. If they say on cost, then cost price is always 100, right? You add your markup, and that will equal your selling price. So it's 100 plus 50 over 150. Also remember, profit markups in your tests and exams can be different amounts: 50, 20, 30, 40, 60. I'm just using an example of 50%. Okay, right. So we need to use this two amounts now, the 100 and the 50. And we're going to take the selling price and we're going to say multiply by what you want. And what do I want here? Remember, I told you they're going to give you the selling price. You need to calculate the cost price. So cost price is what you want, and what you want is the 100. Okay, and you're going to divide it by what you have, and what you have is the 150. They've already given you the selling price. So you're going to say selling price multiplied by 100 divided by 150, and that will give me my cost of sales or my cost price of the goods. Okay, so there's an example. 12,000 multiplied by 100 over 150. So your cost of sales or cost price is 8,000. Everybody understand that? You just need to try and remember that. And also show your workings on your question paper, how you're going to get to this cost of sales. Okay. Then for markup on selling, the rule will change. So here again, we're working bottom down. Okay. So to get from cost price to selling price, we added. So now we're going to do the other way. Okay, now we're going from selling price to cost price. Okay, so we can't add. Now we have to do the opposite and we must subtract. So now selling price will equal 100. Our markup, I use an example of 20%. So I'm going to minus now, and that will give me my cost price of 80%. Okay, so just remember that. Okay. And then again, selling price multiplied by what you want divided by what you have. And what do you want? They're going to give you the selling price. So you need to calculate what you want. So what you want is the 80, and then you divide it by what you have, which is the 100, and that will give you your cost of sales. Okay, and there I've just given you an example again. Any questions there? So in 2.11, the example is on markup on cost, and in your textbook 2.12 is markup on selling. Then you have to use this method. Okay, and in 2.11 you will use this method. Any questions here with calculating cost of sales? And in class I told the students you will only use this methods of markup and cost for when you are for your cash sale transactions, for your credit sale transactions, and for drawings of trading inventory. Only those 3 transactions, not for any of the other transactions. Okay? All right. For example, here in question 2.11, markup of 50%, we will only use it for day 1, day 15, and day 27. Everything else we will analyze on the accounting equation as normal, as what we did in the previous activities. So here now they told us that red grape traders for January 2011, okay, this was the transactions. They used the perpetual inventory system with a markup of 50. So the minute you see that, you will see that they only gave you the selling price. So now you need to use that markup to get to your cost of sales or cost price. Okay, then you do your workings like I did here now. And always remember what you want divided by what you have. Ryan, I'm not sure if you did this exercise in class already. For your wealth. Okay, right. So just remember that. So this is the method, and you write it. Please remember. No, I have not. Okay, no problems. Okay, all right. But now at least, now hopefully, I hope you have a better understanding now, Vuyowetu, so you can now go and try to do this on your own, okay? What you want divided by what you have, okay? And use the selling price. For say for example now, okay, which they can do is they can trick you and say you sold goods, but they now gave you the cost price only, and they now want you to calculate the selling price. So what will you do now? You'll still use the same formula or the same method, okay? But now, instead of having to calculate the cost price, because they've given you the cost price, okay, you now need to calculate the selling price. So that would be what you want. So that will be the one that is at the top, and what you have will be at the bottom. Okay, if they give you the cost price and they want you to calculate the selling price, just remember you'll swap the two amounts around. Do you all understand that? So now it will be the cost price amount, okay, right? And you times it by 150 over 100, and that will then give you the selling price. So always remember, any formula, okay, you can always manipulate. And going forward now into learning unit 3, for these type of calculations, just remember, what do I want? What you want divided by what you have. Okay, now we'll going to go on to the last part of learning unit 2, had to do with inventory systems. So you'll see that all the activities up to 2.11, 2.12, you'll see that the businesses were using the perpetual inventory system. So I'm sure you're wondering, what is the perpetual inventory system? So the perpetual inventory is a system where businesses are able to calculate on a continuous basis what is the value of their cost of sales. They will know that. Okay, so that is with the perpetual inventory system, is that you are able to determine what is the value of your inventory at the point of sale. So you will know that the value of your cost of sales. With the periodic, not, you only be able to determine the value of your cost of sales at the end of the year when you do a stock take. Okay, that is the major difference between perpetual and periodic. Okay, all right. And then more specifically also, with regard to purchasing, with regard to selling, there are also certain differences. When we purchased using the perpetual, we debited an asset account known as inventory. But now with a business, and most of our small, very small businesses, they will use the periodic, and most of our bigger businesses that are like our Checkers and our Woolworths, they will use the perpetual inventory system, also because they have that inventory software management system available to them, okay, with the infrared scanners, and okay, that allows them to immediately know what is the value of the inventory. Whereas in a periodic, with a business using the periodic inventory system, they might just have a normal cash register, no specific scanning or infrared um, um, that they are using to scan the items as they are leaving the business. Okay, so then they will debit to an expense account now, not an asset account, but a new expense account known as purchases. Okay, all right, so just remember that that is also another huge difference between the two inventory systems. With perpetual, when we purchase, our account that is affected is an asset account known as inventory, but in the periodic, it's affected by an account which is an expense, and the account's name is purchases. And then in your textbook, you'll see number 2, there's a lovely table on page 70 in your textbook. It explains to you there when inventory is sold with the perpetual, we will have 2 double entries like we were practicing now. We said debit the bank, credit sales, debit cost of sales, credit trading inventory. With the periodic, we only do the first double entry of debit the bank, credit sales. We do not do any entry for cost of sales, so we don't do the second part. Okay, and then at the end of the financial year, what happens is that with the perpetual inventory system, um, we are able to calculate the cost of goods sold at the point of sale, whereas with the periodic inventory system, we will have to do a physical count. And I'm sure you've seen or heard of a stock take. That is what they mean by physical count. A stock taking will have to happen at the end of the financial year for the business to determine the cost of sales. Okay, so just remember those are the very important differences between the two inventory systems. So always remember they will ask you, they could ask you, which inventory system is this business using, for example? Okay. And how will you know they're using periodic? When the account that is debited for when inventory is purchased is purchases. So the minute you see purchases, or you also see transport costs like carriage on purchases, import tariffs, custom duties, then you know that this business is using the periodic inventory system and not the perpetual inventory system. Okay, any questions there regarding the two different inventory systems? A good exercise to practice would be question 2.13 and also working through the example 2.13 in your textbook, where they first want you to show the entry in on the accounting equation using the perpetual inventory system and then again using the periodic inventory system. Okay, most business also uses the periodic. Okay, they find it much easier. It's more cost effective. Like I told you, they don't have to invest so much money in an expensive inventory management software system. Okay, right. But those other advantages, disadvantages, and also how to calculate the cost of sales of a business using a periodic inventory system, that calculation will be discussed more in depth in Learning Unit 6 with your lecturer when you come to that learning unit. Any questions there? Since we didn't actually take a break, we've been continuing one way. I was assuming that is because you actually wanted to finish earlier. So now yeah, it will be perfect timing. Okay, so, but please, if there's any questions, anything you want me just to go back to now, you still have time because our time together was from 2 till 5. Anything you'd like to ask Michaela, Leandy? I'm at your disposal for now. Just remember for your test, this recording hopefully will be available to you by Monday. Okay. Right, they will upload it and then it will be you remember it will be on the VC student intranet. That is where you'll be able to get all these catch-up videos. So for your test, remember now this is only 2 of the learning units. Your lecturer will be starting soon with learning unit 3. Okay, so that will also be in your test, and all you're going to be seeing now is you're just going to be building onto this existing knowledge that you already have. You know all the different business transactions. All we're now going to do is to classify them. How are we going to calculate VAT? Are we going to be which the VAT categories? Okay, and then again, markup. Also, again, you're going to be covering the markup calculation. So please, it's very important that you actually understand this, what you want divided by what you have, because this will really also help you now in learning Unit 3. Okay. And just very important again, just please study this, especially when you're analyzing transactions on the accounting equation. If they're going to ask you to do T accounts, that is to show the double entry in your T accounts. They could ask you that. Also, that is question 2.9. Then, let me just take you. Then you must remember this double entry rules. Okay, now then you use this. This will be the double entry rules for T accounts, and the one that I showed you, okay, when we were doing the accounting equation, that is the one you need to remember for accounting equation. Okay, all right. So just remember when you're going to do double entries for T accounts, then you have to remember this. Okay, and always just um, remember also that when you are posting from one account to another, we talk about cross-referencing. Maybe we have some time there. If you can maybe just look at example on page 54, page 54 in your textbook, page 54 in your textbook. What is cross-referencing? It is general practice to include a cross-reference in every T account. So they're talking about these T accounts. When an account is debited, we will write the name of the contra account that is credited as a cross-reference. And when an account is credited, we write the name of the contra account that is debited as a cross-reference. Okay, so if you have your textbooks, Ryan and Michaela, you will see that on page 54. Right, I thought I could. Okay, I'm just looking for some space here for me to draw here, so I can maybe show you an example. Okay, this. Okay. I'm just going to say, for example, that is capital, and then you have a bank. Okay, and then you have, of course, your left-hand side, which is the debit side, and then your right-hand side is the credit side. Okay, now this is what they mean with cross-referencing. Okay, the double entry is when the owner contributes money into the business, it's debit the bank, credit capital. Okay, so when you do your debit entry for the bank, you always start off with your debit entry. You have to write the what did the notes or the definition explain to you there? When you write the name, when an account is debited, we write the name of the account that is credited. So we know it's debit the bank, credit capital. So when I do the debit the bank, I will write capital here. Are you with me? Okay, and the amount. And when I do the credit entry, I will write the debit account's name. So here then I will write bank. Okay, and the amount. And there's your debit and your credit. So this is how you do double entry in T accounts, and this is cross-referencing. Cross-referencing is to name the contra account, contra account. Okay, so please do work through example 2.11 in your textbook for cross-referencing. That is on page 54 and page 55 in your textbooks. Anything else that you'd maybe want me to go through? Michaela Ryan, since you do have a textbook, I didn't go through all the examples. I tried just to cover the main important things there. Question 2.6 also, good for you to practice so you know what are the different accounts for that is also how it could be asked in the tests or exams where your different classifications, non-current, current, so they give you a whole list of accounts and you need to say, is it an asset, is it a liability, an income or expense account? Okay. And those that don't have Liandi and Fuyu Wealthu and Mpumalemo, do you have a textbook? Okay, wonderful. Okay, so at least then now you know which are the activities you can go back now and practice. Okay, so first study your chart of accounts before you do question 2.6. Okay, and in that way you are testing yourself, okay, to see whether you know what are the different types of accounts on your um, chart of accounts, okay, and how to classify them. Anything else? I think that gives us your 10-minute break now. Anything else you'd like to know? Leandy, I hope you have a better understanding now of learning unit 1 and 2. Okay, perfect. Thank you. Thank you. Okay. I know you just need to, it could be, like I say, yeah, it's a lot of information I shared now with you. Hopefully when the recording is available, you can also go back to it now and then use it as a form of support and guidance as you're preparing for the upcoming test. Okay. But just go back, go through the theory, even if you have to read it 2 to 3 times over and over, you will see. I always tell the students, if you understand the theory, then the application will become so much easier because the theory actually tells you what to do. Even now with that question also that I said now of the 2 inventory systems, it tells you exactly what you need to do. what is the difference between the two inventory systems. It's telling you that purchases is an expense account for the periodic, and therefore you're going to have to debit it. So can you see, if you study the notes, it tells you how you need to apply it when you're now going to practice the activity for the periodic inventory system of analyzing transactions. But thank you very much. If there's no other questions, Ryan, are you all good for learning unit 1 and 2? I'm not sure, have your campus started with learning unit 3 already?
Yeah, we have. We
Oh,
almost finished with 3.
oh my goodness. Okay.
Yeah.
Okay. So you will be doing revision this next few weeks. Okay.
Yes.
Okay. Okay. Yeah, no. Okay. Um, so no questions?
And I'm good. Thank you
Are you
very much
good?
for the lesson.
Listen, thank you.
I'm all good
Pleasure.
this side.
Life
Thank you so much for your time and
time.
effort.
Thank you, Michaela. All the best. All the best. Michaela and Leandy, don't worry. I will be um, on campus or in class there to help you. Okay. Thank you, Vuyovitu. Okay. All the best. Have a lovely weekend, everyone. Thank you. Bye-bye. Bye-bye. Thank you. Same to you, Ryan. Bye.